Good afternoon, everyone. It's our pleasure to welcome you to yet another enriching webinar on the crucial topic recent developments in financial reporting for non-corporate entities, hosted by the Accounting Standards Board of the ICI ASB. This marks the fourth session in our Brain Gain Expertise series, where we focus on delivering valuable insights into the practical application of accounting standards. Today, we have with us CA Ashish Agarwal, the eminent speaker of today's webinar. A warm welcome to you, sir. Now, I would like to briefly introduce CA Gaurav Mittal, who will be moderating this session. CA Gaurav Mittal is a senior manager at one of the global consulting firms with over 8 years of experience in statutory reporting, technical accounting, IPO advisory, audit readiness, accounting policy manuals, gap conversions, etc. Prior to this, he spent 6 years with one of the big fours where he supported clients across diverse industries in financial reporting matters such as telecommunication, energy, tech-based startups, etc. CA Gaurav Mittal has supported clients in complex technical accounting matters, including associate accounting, sale and leaseback transactions, principal versus agent evaluations, broker trade classification under IS2, business combinations, and hyperinflation accounting. He has supported clients in preparing and reviewing accounting policy manuals. With this now, I would request CA Gaurav Mittal to start the webinar by giving a brief introduction of our eminent speaker, CA Ashish Agarwal.
Thank you.
Over to you, sir.
Thank you. With that, let me warmly welcome our speaker today, CA Ashish Agarwal, who will walk us through this development the non-structured entities development in much greater depth, including practical insights for recent engagements. Let me give a brief introduction of Ashish. Ashish Agarwal is a qualified chartered accountant with over 5 years of experience in financial reporting, controllership, and audit. He has worked with renowned organizations that includes GT, Deloitte, Goldman Sachs. At present, Ashish is currently at manager in one of the big four practice of accounting advisory services. He has also earned bronze badge in investment banking and capital markets, reflecting his dedication to professional growth and deep expertise in financial domain. Ashish, we are thankful for you over here. So over to you.
Thanks, Gaurav, for a warm welcome and the brief introduction. And it will be an honor to present this format on this webinar and format of financial statement for non-corporate entities. I think we are ready to start with the session. Let me present my slides with the presenters. So let me start with this slide. The format for financial statement for non-corporate entities. As you all know, the agenda of today's session, we will going to cover the purpose, scope, and applicability of the guidance note. Then I'll give you a brief about what non-corporate entities are, and there is a revision in structure of guidance structure of non-corporate entities. And applicability of accounting standard on them, like there are certain exemptions and disclosure exemptions given to the MSME entities, and after that a general instruction for the preparation of balance sheet and the profit and loss statement, and a brief about the same. So we'll start with our first topic, that is purpose, scope, and applicability of the same. So as you all aware that what is the earlier position, the ICI through the accounting standards cover all the recognition, measurement, and disclosure requirement for the non-corporate entities. However, there is no prescribed format of presenting the financial statement through the accounting standards. Even today, accounting standard doesn't prescribe the format for presenting the financial statements. However, the disclosure requirement are still there in the accounting standards. So just to improve the implementation of the standard, ICAI's accounting standard board has issued a guidance note now in 2023. Earlier also there is an technical note that was published in year 2022, but that was not mandatory in nature. Even today, the guidance note is not mandatory on the management. However, it will be mandatory through the members in practice. Now, what is the effective date for this guidance note? This guidance note is applicable from on or after periods starting after 1st of April 2024. That means any period which is prior to this date, 1st April 2024, this guidance note is not applicable. So let me walk you through an example. Let's say there is an HUF which is subject to tax audit for financial year 2023 and 24. And due to any of the situation, any unforeseen circumstances, tax audit was not signed prior to 31st March 2024. And let's say tax audit report was signed by the CA on 4th of April 2025. That is after the effective date of this guidance note. So the question here arises whether the CA in practice needs to follow this guidance note. The answer is no, because guidance note is applicable for the financial period that covers the period starting on or after 1st of April 2024, and in our case, the period that was signed by the CA in practice is prior to 1st of April 2024. Now, what covers under the financial statements through this note? I just covered in very simple manner. The components of financial statement include balance sheet, our statement of profit and loss that we generally said as sometimes profit and loss account, related notes like notes to the accounts of balance sheet and P&L, and general instruction of the same. As I already covered the historical evolution, in June 2022, they institute ICAI through Accounting Standard Board issue a technical guide on financial statement, which is recommendatory in nature. That means even the CAs are not bound with the technical guide. And in August 2023, ASB again issued this particular guidance note, which we are going to cover today. For the financial statements of non-corporate entities, and it also covers the illustrative format for the face of balance sheet, statement of P&L, and the note of accounts. And also they had issued an Excel file that gives us a detailed disclosure of the entire financial statements. So the biggest question arise as of now is whether this guidance note is mandatory or a recommendatory in nature. So in general sense, we can say that this guidance note is not mandatory, but yes, considering the Code of Ethics edition 2022 and prior ICAI announcement, we can say that this guidance note is mandatory for CA in practice who are performing attestation functions. The keyword here is while performing the attestation function. It's not applicable when they are following any other function. It's just the attestation function. Now, next question arises whether this is mandatory for the non-corporate entities or their management to follow this particular guidance note. Answer is no, because again, the answer is simple. The management is not bound by the ICAI, the CA Act, or the Code of Conduct. It is but the CA in practice are bound by the same. Now, what is the practical challenge that we can face while in practical? Let's say there is one or two of our clients, and we on which tax audit is applicable as per Section 44EB of the Taxation Income Tax Act. Tax audit is applicable, and we have to issue report in Form 3CB. Now, what does it mean? This particular service comes under the attestation service of CA in practice. So first, CA, that particular CA in practice have to tell the management to follow this guidance note for the preparation of their financial statement. However, management can say that no, we are not bound by the ICI code and we are not following this particular guidance note. In that particular situation, what CA in practice has to do? Any answer from hello? Gaurav, are we like having an interactive session, or it's just like can community ask question in between the session with us?
See, it's better to have a questions at the end because there might be chances that various questions you will covering throughout your presentation.
Okay, no problem. No problem. So I'm just covering this practical challenge. That's why I'm asking. So in this particular situation, what the CN practice has to do, whether to leave that particular audit, whether or what is the situation that he has in this particular situation he has to do? Just nothing. He has to put the qualification in his para 3 of Form 3CB. And the nature of qualification is not like it is not a misstatement or there is no error in the income, expense, asset, and liability. It's just non-adherence format, non-adherence to the prescribed format. This type of qualification we have to give in the Form 3CB. In the later slides, I have covered a sample language for what kind of qualification we can give. So here is the summary snapshot from where I can this thing. Where is the marker in Zoom? One second. I'm just looking out for the marker in screen. Yes. So here it is given a summary snapshot of the same, like on whom it is applicable, whether this particular guidance note is applicable only for the CA in practice, but not in the on the management. And when it is mandatory only during the attestation engagement. Now coming to some of the example to understand it more deep. Let's say there is a partnership firm that is in the process of availing a government subsidy, and that particular government required them to submit the financial statement for the last 5 years, including the year which is ending on uh, ending on 31st of March 2025. That means this is the period that comes after the effective date of this particular standard. Now, the question is, there are three questions in fact. First of all, whether this guidance note is mandatory to be followed by the firm, whether this guidance note needs to be ensured by the CA in practice, and to answer the second question, first we need to understand whether this particular services comes under the attestation services or not. Answer is yes. This particular service come under the attestation service of CA in practice. And to answer our first question, this particular guidance note is not applicable on the firm, but yes, it is mandatory to be followed by the CA in practice. Now, there is a practical challenge. In our particular case, the government wants to submit the financial statement of last 5 years, and this guidance note is applicable only after a period starting after 1st of April 2024. So the question arises here: do we need to prepare all 5 financial statements in this particular format? or only the one? Practically, I can say that if we are submitting any financial statement to any government or to any bank, it needs to be inconsistency. So practically, all the five financial statements needs to be prepared following this particular guidance note. Covering another example of a partnership firm which again wants to raise a loan from a particular bank, and this particular bank wants them to submit their financial statement duly attested by the CA, and we are again making an assumption that tax audit is not applicable in this particular case. Again, the question is whether the firm needs to follow this guidance note, or whether the CA in practice needs to ensure the compliance of this guidance note. Answer is same. Firm is not bound by the guidance note, whereas CA in practice needs to ensure the compliance of this particular guidance note, because this service again falls under attestation services. Now the question arises, what is the need of this guidance note? Now, I can say that, the transparency, comparability, and objectivity is the major player. A uniformity in financial statement. Let's say if we are comparing financial statement of multiple partnership firms or any other non-corporate entities, how we can compare if they are not consistent. Someone is following the horizontal format, someone is following vertical format, someone is maybe providing the movement, may not be providing the movement. So just to make them comparable and easy for the users, we can say it is required to have some uniformity, and uniformity comes only if there is a particular standard or a particular format, prescribed format that followed by all of them. So these all are the benefits of having a guidance note and the prescribed format, like need for the robust reporting, and that in past few years we are emphasizing on Make in India projects, and most of them are non-corporate entities, MSME sectors that are participating in this particular drive. So we can't leave them behind in the success of the nation, can say. So coming to the next part, this is a sample that I mentioned 2 slides back. How we can put on a qualified opinion if someone is not following this particular guidance note. So it is just an illustrative example. We have to put in 2 paragraphs for the qualified opinion. One is the basis for qualified opinion, and one is the qualified opinion. In the basis of opinion, we can say that the financial statement of the entity have not been prepared in accordance with the format of financial statements prescribed in the guidance note. So the question arises whether not following this particular format would lead to any misstatement or incorrection, or any not showing any true and fair view. Answer is no. The numbers are still correct. There is no impact on income, expenditure, asset, liability balances. It's just only that the client is not following the format prescribed in the guidance note, and we have to put that much qualification that this particular client is not adhere to the formats only. And in the qualified opinion, we gave that basis the matter which is described in the basis of qualified opinion paragraph. All other aspects of the financial statements are presented fairly in all material aspects. So this can be used as an illustrative note for the for putting a qualification for not following this particular guidance note. Now the question arises, what is the non-corporate entity? What is a non-corporate entity? As per the definition, any kind of business or professional entity that is not incorporated under Companies Act or the Limited Liability Partnership Act are considered to be non-corporate entity. A few examples of the same are sole proprietorship, QF, any partnership firm, whether it is registered or unregistered, any association of persons like RWA authorities, body of individuals, any registered organization, whether societies, trust may be registered or unregistered, statutory body, corporation, any authority. These all are the example of non-corporate entities. In later slides, we will cover how the accounting standard applicability requirement for non-corporate entities as well. Also, the guidance note talks about some special, they had given some special benefit to the societies. For example, any societies that is registered under a particular state act and there is a prescribed format to be followed in this of that particular state. In case of any society or the public trust, whether those non-corporate entities have to follow this particular guidance note, answer is no. The guidance note provide an example of Maharashtra Societies Act. The entities registered under those act would need to follow the prescribed format by that particular act, not by the format given in this guidance note. Now we are coming up to the format of financial statement. Normally, there are two kind of entities, I can say. One is which are incorporated under the Companies Act, another one which is incorporated under LLP Act, and all others. For the companies which are incorporated under Companies Act, we have Schedule 3 for the that provides the format for preparation of financial statement. And for the non-companies, that covers non-corporate entities and the LLPs, we have prescribed guidance note. Guidance note for the LLP is similar in nature to the non-corporate entities, and we are covering non-corporate guidance note for non-corporate entities in this session. Now we are coming on to the set of accounting standards and their applicability. At present, we have three sets of accounting standards. One is Ind AS. Another one is accounting standards, which are that are notified under Companies Accounting and Standard Rules 2021 for all the companies which are not following the Ind AS. And for all other entities, we have accounting standards that are prescribed by ICAI. So at present, we can say that Ind AS is applicable for all the listed companies, all the NBFCs, and all the unlisted companies or NBFCs that have a net worth of more than 250 crores and their subsidiaries and joint venture of such companies. Whereas the accounting standard is applicable for all the corporate entities other than those who are required to follow or apply Ind AS. As on date, we have accounting standard 125, 7, 7, and 9 to 27, which are effective and applicable for small and SMCs with certain exemption. For the purpose of non-corporate entities, we have accounting standards, and non-corporate entities are also classified under two categories. One is large and other is micro, small, and medium enterprises. Earlier, we have 4 levels of non-corporate entities: level 1, 2, 3, and 4. So these we can say that level 1 covers the large non-corporate entities, and level 2, 3, 4 covers MSMEs. Large non-corporate entities have to apply all the accounting standards and their disclosure requirement, whereas for MSMEs, MSME, I mean to say level 2, 3, and 4 non-corporate entities, there are certain exemptions in applying accounting standard and some relaxation in disclosure requirements as well. Now the question arises, what are non-corporate entities? We'll cover in next slide, upcoming slides. So these all are the standards that are applicable. These all are the standards which are applicable for micro, small, and medium enterprises that covers under level 2, 3, and 4. We will cover what are level 2, 3, and 4 entities. For the time being, we can say that these level 2, 3, 4 entities cover micro, small, and medium enterprises. Now, for them, there are certain exemptions. For example, AS3, cash flow statement. Cash flow statement is not required. Cash flow statements are not required to be prepared by micro, small, and medium enterprises, or we can say the entities or non-corporate entities that covers under level 2, 3, and 4 category. Coming next, we can say that I'm just covering, the major accounting standard here. And with the PPT, we can easily identify what is applicable and what is not applicable, and the disclosure requirement with an exemption. For accounting standard 10, that talks about the accounting for plant, property, and equipment, or we can say the fixed assets. There is an exemption for level 3 and level 4 category. As you can see on my screen, level 3 and level 4 categories. Accounting standard 10 talks about some additional disclosure requirements. Or I can say the correct word used in the standard is encourage disclosure requirements, that talks about the carrying amount of ideal PP, any ideal PP that we are not using, the cross carrying amount of any kind of assets that is fully depreciated but still in use. What does it mean? Fully depreciated, we can say that let's say we purchased an asset worth rupees 1 lakh 10 years back, and using the straight line method, in 10 years, the particular asset is fully depreciated, but the business is still using that particular asset. So in general, we have to disclose that particular gross carrying amount of such fully depreciated asset. But because of the applicable disclosure exemption, such kind of disclosure is not required to be given by level 3 and level 4 entities. Next, we can cover the foreign exchange. Foreign exchange, we have, in simple words, we can say we didn't have any disclosure requirement to give what we can say it the foreign currency fluctuation risk management policy. For example, we are making some non-corporate entity is exporting the services, or I can say any other thing that they had export. So what they will get in return? Their revenue will comes in foreign currency. Let's say in dollar. They had exported something to US, and now the revenue will come in dollars. There is a credit period of 1 month, so there is a risk of currency fluctuation within that 1 month, and to hedge that particular foreign currency fluctuation rates. Let's say they had entered into a forward exchange contract with a particular banker. So what this particular hedging is, this is the foreign currency risk management policy of that particular non-corporate entity. And with this, we are not required to disclose that particular policy of that non-corporate entity in our books. Just give me a second. I need to put on my charger. Just one second. Similarly, we have other exemption in like AS12, which is applicable for all the MSMEs. There is an amalgamation which is applicable again for all the entities except the level 4 entities. And now we have like the related party disclosures, I can say AS18. Related party disclosure, like I can also say that related party disclosures are governed by the accounting standard, not by this guidance note. And if there is any requirement specific in accounting standard, the accounting standards will supersede this guidance note. For what does it mean? It simply means if there is a disclosure requirement in accounting standard, but the same disclosure requirement is not there in this particular guidance note, and through the guidance note, that disclosure requirement is not specifically excluded, that non-corporate entity has to give this that particular disclosure. In case of AS18 related party disclosure, level 3 and level 4 entities are fully exempt to give related party disclosure. Now, what does it mean? It simply means they don't have to give the schedule of related party disclosure, but let's say there is a requirement of tax audit that specifically mentioned to give related party disclosure. We have to follow that particular rule. Like in general, also the partnership firms or the sole proprietors, if they are having any related party transaction, it should be they disclose it in their financials earlier as well, and they have to continue that practice. Uh, Next, we are covering the AS29 provision, contingent liabilities, and contingent asset. This particular standard is applicable to all the MSMEs, level 2, level 3, level 4 entities, but there is an exemption in disclosure requirement. What are those exemptions? As per the guidance note, paragraph 66 and paragraph 67, they are not required to give those disclosure. What that covers? Paragraph 66 covers the movement in the provision. Like for each and any kind of provision that entity is making, they have to give a disclosure of their opening balance, closing balance, any new provision made during the year, any amount that they had used during the year out of those provision, and any amount that is reversed. Now they are not required to give that particular movement in provision. And para 67 talks about uh, nature of such provisions, details about such provisions. And now small companies don't require to give the nature and uh, any detail about that provision. Now, the next question comes that I was talking about. What is non-corporate entity? This is the revised criteria. Earlier, we have 4 level of non-corporate entities, level 1, level 2, level 3, and level 4. Now, we can easily say that level 1 entities are large non-corporate entities, whereas level 2, 3, 4 are micro, small, and medium enterprise non-corporate entities. This guidance note is applicable for all levels, but this is about the accounting standard requirement. Level 1, large non-corporate entities has to follow all the accounting standard, and level 2, 3, and 4 have some exemption in disclosure requirement, as well as in following the entire accounting standard that we covered in our prior slides. In simple words, just to summarize this particular table, we can say that what is micro, small, and medium enterprise? Any enterprise that is not listed and nor in the process of listing. In simple words, its equity or the debt securities are not listed or nor in the list in the process of any listing. It should not be any bank or any cooperative bank, financial institute, or any entity that is carrying the insurance business. Any entity that is having a turnover the preceding financial year less than 250 crore and a borrowing of less than equal to 50 crores are considered as micro, small, and medium enterprise, and all entities other than that covers under level 1 large non-corporate entity. In details, I can say that any entity that is having a turnover excluding the other income, please note that it covers it doesn't include the other income, and the turnover that we are calculating belongs to the last year, the previous year or accounting year immediately preceding the current accounting year. If that particular turnover is greater than 250 crores, it falls under large non-corporate entities and all the accounting standards are applicable to them. If it is uh, in between 50 crores to 250 crores, it comes under level 2. If it is in between 10 crores to 50 crores, it comes under level 3, and all other than that comes under level 4. Similarly, for the borrowings, it includes all the public deposit at any time. Please mark the word any time during the preceding financial year. What does it mean that? Let's say if any entity is having borrowing during, let's say in December, more than 50 crore, but as on 31st of March, it is having an borrowing of 40 crore. Will it, can I say that it will comes under level 1? Answer is yes. And other criterias are given for level 2, 3, and 4. Listing status is applicable only on level 1 entities. That is why I'm saying in simple, any entity which is not listed nor in the process of listing would automatically comes under level 2, 3, 4 if the condition also satisfied. Any entity which is holding subsidiary associate of level 1, level 2, level 3, 4 entities would also called as would also gain the similar status. What and why we are studying for the applicability of accounting standard? As I mentioned earlier, level 1 entity has to comply all the accounting standard and all the disclosure requirement, whereas we have certain exemptions or relaxation for MSME. I hope this is clear. We have some additional disclosure requirements for the MSMEs that we'll cover in our later slide, next slide. And after that, we'll cover some examples. Now, these are the other disclosure requirement. If there is any entity, or we can say the non-corporate entity, that is that falls under level 2, 3, and 4, will automatically get the MSME status, and they have to disclose this particularly in which level they are, and they all the accounting standard that they are complying. Important point comes here. What if an entity is MSME in earlier years, and in current year it comes its category changed to level 1, that is large and non-corporate entity? What is the impact? The impact is they have to apply all the accounting standard in the current year. Now the question is, do we have to revise the comparative period figures as well? Answer is no. There is no need to revise the prior figure as per the revised criteria. But we have to disclose this particular thing in our notes to accounts, that we have to state this fact that earlier we are the micro, small, and medium enterprise, and in the current year our status gets changed from MSME to large, and that is why we are not not revising the prior year figures. Next is the vice versa case. What if there is any entity which is level 1 but now comes to MSME status? Question arises whether they can avail the exemption or the given exemption right from the same year. Answer is no. They can apply, or they are eligible to avail the exemptions only after 2 consecutive years of non-level 1 status. What does it mean? In simple words, let's say in a particular year, a non-corporate entity is under large category. Next year, it comes under MSME category. Whether they can avail this exemption? Answer is no, because 2 consecutive years doesn't pass of leaving their status of level 1. We'll cover later on in details with the help of some examples. And this is again a disclosure requirement. If an entity is availing any exemption, they have to disclose this particular fact, that which for which standard they are availing the exemption. And if an entity opts not to avail any exemption, they are free to comply with all the accounting standard. There is no foundation that you have to avail any exemption. They can give the full disclosure as well. Now coming to some example. This is the case of a sole proprietor, and the question is whether they, based on the facts, whether this is an MSME for financial year 2024 and 25. The nature of this is non-corporate entity, as it is a sole proprietor. It is a non-corporate entity. It is not listed anywhere. The turnover of the same is 250 crores, including interest income on deposit. And the borrowings are 35 crores. There is no, it is not any holding or subsidiary of non-MSME entity, and it is not a financial institution. The question is whether this is an MSME for financial year 2025, 4 or 5. We have to check. Now coming back to our criteria, what criteria says? The large entities having a turnover more than 250 crore or more than 50 crores comes under the category of level 1 entities. Turnover doesn't include the other income, and the borrowing is at any time during the preceding financial year. In our case, what we have? The answer is this is an MSME. Why? Because in the preceding financial year, its turnover is not more than 250 crore. We have to exclude the interest income because this is the other income, and borrowing is not more than 50 crore. Second case, again of the same proprietorship. The nature is non-corporate entity. It is not listed anywhere. The turnover in the preceding financial year is 180 crore and the borrowing is 50 crore. Please mark that it is having a borrowing of 50 crore. Whether this is an MSME for 2024 to 25. Again, the answer is yes. It is an MSME because the definition says more than 50 crore. Less than or equal to 50 crores comes under the category of level 2. So it is an MSME. Next case of an education trust. Again, the question is whether we are evaluating whether this is an MSME for 2024 to 25. The nature is non-corporate entity, as it is an trust. Listing status, it is not listed yet, but this is in the process of listing. There is a concept of social stock exchange also introduced by SEBI back few years back. So an education trust can also list themselves in social stock exchange. It is having a turnover of 80 crore and a borrowing of 10 crore. Now the question is whether it is an MSME. Answer is yes, because it is in the process of listing. So it will come. It is not an MSME. It is an non-corporate entity having within the category of level 1 large enterprise. What does it mean? It has to comply all the accounting standards. Next question is again of a sole proprietor, and we are evaluating whether it is an MSME for the financial 2024 and 25. As it is a sole proprietor, it is a non-corporate entity. It is not in the process of listing. It is not a subsidiary of non-MSME entity and not a financial institution or the insurer. Now we are having some facts of its turnover and the borrowing. In the year 2022 to 23, it is having a turnover of 260 crore and a borrowing of 52 crore. So we are assuming that it is an MSME in that particular year. Also with the current definition, it is an MSME. In the year 2023 to 24, the turnover comes to 240 crores and the borrowings is 55 crore. Again, it is not an MSME in this particular year because of the borrowings. In 2024 to 25, the 55 crore, and we are assuming that borrowings are less than 50 crore during the entire financial year. So it will gain its status of MSME in this particular year. Now the question arises whether it can claim the accounting standard exemption that is applicable to MSME in financial year 2024-25. The answer is no. Why? Because in other requirements, we read that if entity in the previous slide, let me go to the previous slide, you can see here we read that if there is an entity that comes from non-MSME to MSME category and it avail exemption immediately, answer is it can avail exemption only after 2 consecutive years. And in our recent case, 2 years has not been passed. That is why it cannot avail the exemption available to MSMEs. Let me walk you through some other example, a few more examples. Case 5. An entity, again, a sole proprietor. Because of the sole proprietorship, it is a non-corporate entity. It is not listed nor a subsidiary or associate of any non-MSME entity. We are having details of its turnover and borrowings, and we have to evaluate whether it can avail exemptions in financial year 25-26. In the year 2021 to 22, it is not an MSME. Again, in 22-23, it is not an MSME. In 2023-24, first time it gets the status of MSME because its turnover is less than 240 crore and borrowings are again less than 50 crores. And we are assuming that all other conditions are satisfied. In 2024-25, it is maintaining its status of MSME. So whether it can avail the exemptions available in next financial year 25-26, answer is yes, because 2 years of its level 1 status has been passed. The 2 consecutive years, it is able to maintain its status of MSME. Now in the 3rd year, it can avail the exemption applicable for MSMEs. Similarly, another example of a sole proprietor, and again we are evaluating whether it is an MSME for MSME, and also can it avail exemption financial year 2025-26. I think there is some typing error for 2025-26. We have to evaluate it for 25-26. In the year 21-22, it is a non-MSME entity. 22-23, it is an MSME. Again, it is an MSME. And 24-25, again, it is an MSME. Now in 25-26, its borrowing crosses the limit of 50 crore. That is why it loses its status of MSME and comes under the category of level 1 non-corporate entity, that is large non-corporate entity. Whether it can avail AS exemption, answer again is no, as it loses its status of level 2, 3, and 4 and become a level 1 entity in current year, non-corporate entity in current year. Now, while preparing the financial statement, we have some general instructions that we need to follow. while preparing the financial statement. What are in general, the instructions are similar to what we have in Schedule 3 for the companies, and the formats are also similar. But we cannot say that it is exactly similar to what we are following in Schedule 3. So the applicability and the format customization. This guidance note describe the format for balance sheet, statement of P&L for the non-corporate entities, and there is no foundation to use it as it is. It allow you to make modification in heading, subheading, disclosure, or any structure to comply with the requirement of accounting standards. You may use terminologies or adopt terminology according to your status. For example, in case of sole proprietor, there is no equity. It's the capital account. So you can change that particular terminology. In place of equity, you can use capital. Similarly, in case of any trust, you have corpus. So you can use that particular word. In case of HUF, there is no partner. It's the karta. So you can use that particular word at the signing point. Now, the disclosure requirement. This is a bit important thing. Disclosures in the prescribed format are in addition to. Emphasis is on addition to and not in the substitution for any disclosure that is given under the accounting standard or any other legal statutory requirement. Simple words, we can say that accounting standards will prevail over guidance note. If, as I mentioned earlier, if there is anything that is not particularly excluded from the guidance note, or is there any disclosure requirement that is not given in the accounting in the guidance note, but that particular disclosure is required to be given as per the accounting standard, then we have to disclose that particular thing in notes to account by way of additional statement, unless and until it is required on the face. For this, I can give an you can say accounting standard 10. Let's say, or accounting standard 10, that is for the financial assets, accounting for the fixed assets, sorry. Let's say there is an entity, non-corporate entity, that is having three kind of buildings. One is the office building, another one is a factory building, and the third one is any other building that is not that he or she didn't decided yet whether it was used in the business or it is for the personal use. Not sure where to use that particular thing. What will happen? Where we will show that particular building? Whether we have to show it under the PP schedule or anywhere else. What we had seen in some cases, people shown it under the PP, which is not correct. As per the accounting standard 13, which talks about the investments, it will be considered as investment property. We have to show it as an investment property. What is the definition of investment property? First, we will evaluate that. Any enterprise holding investment properties, any investment would be classified as long-term investment. We are reading it. Any investment classified as long-term investment should be carried out at cost. So what is the problem arises here? Someone says that when we are showing it as an plant property and equipment, we can avail depreciation on that. However, if we shown it as an investment property, we cannot avail the depreciation. But accounting standard 13 again says that any investment that is classified as long-term investment should be carried in the financial statement at cost. However, the provision for diminution shall be made to recognize a decline other than temporary in the value of investments, and such reduction being determined and made for each investment individually. Further, it says that any reduction in the carrying amount or any reversal of such reduction should be charged through the profit and loss account. So by this, we can say that the depreciation can be charged on investment properties as well. Again, next, we are covering the notes to accounts. Notes to account must provide the explanation breakdown of all the items of the financial statement. For example, the PP. On the face of balance sheet, we are disclosing the PP, but in the notes to accounts, we are providing the details of each class of assets. So the explanation and breakdowns of all the items of the financial statement must be provided, and we have to maintain a balance. What does it mean? We have to maintain a balance means that the details should be relevant to the business and to the nature of the entity. It should we should avoid providing too much details or any over aggregation of the same. What about the comparative information? There is an exemption given if the entity, except for the first time financial statement, previous period figures must be presented. What does it mean? If the entity is preparing its financial statement for the first time, there is an it is not required to give the previous year figures. Next points, rounding off. This particular requirement is similar to what we have in our schedule 3. If the total income is less than 100 crore, we have to round off the figures nearest to the 100,000, lakhs, millions or decimals. And if it is 100 crore or more, we have to round it off to nearest lakh, million or crores or in decimals. But there is a difference from schedule 3. This is optional in this guidance note. If you read the exact language of guidance note, it was written as may, the guidance note. So this word makes it optional. Whether to adopt it or not, it is on the professional judgment. The terminologies again, it must be aligned with the definition given in the accounting standards, and the minimum presentation requirements are this particular format set out the minimum disclosure requirement on the face of balance sheet and the P&L, and we are free to substitute it or add any other details or according to the nature of the business or the non-corporate entity. If there is any other requirement given by by any accounting standard or statute that must be followed, this guidance note provide only the minimum presentation requirement. Covering the other parts. This I will cover with the financial format of financial statement. Just give you a brief. This talks about the what is operating cycle, what is current asset, and what are current liabilities. Operating cycle is in general we say that a period of 12 months is considered have duration of 12 months is considered as operating cycle. But in some cases, operating cycle period is more than 12 months. For example, uh, uh, in wine industry, the realization of cash and cash equivalent or the process of acquiring the asset processing and their realization is more than 12 months. In that case, the operating cycle could be more than 12 months. What is an current asset? If they are satisfying these in general, if it is expected to realize within next 12 months after the reporting date, it is considered as current, otherwise non-current. And similarly for the current liabilities, in details, we will cover it with the format of financial statement. Now, this guidance note gives you the format of financial statement, and for that I will use an Excel file where detailed disclosures are given in this guidance note. Just give you an overview of the phase. It is similar to what we have in schedule through with some terminology changes like in owners fund, partners fund, there we have equities, shareholders fund. These terms are we can change. according to the status of non-corporate entities. As I mentioned earlier, if it is a partnership firm, we can use capital and liabilities. If it is a trust, we can use corpus and liabilities, and accordingly, these things can be changed. A reserve and surplus. We can say that in case of sole proprietor or partnership firm, in general, the profit to the surplus is transferred directly to the capital account. In that particular case, there is no, we can say, reserve and surplus. What we will do in that situation? Just strike it off. We are not required to give any line saying reserve and surplus if there is no reserve and surplus. Next one is the non-current liabilities that covers long-term borrowings, deferred tax, other long-term liabilities, long-term provision. We will cover these all in details with the Excel. I'm just walking you through on the face of with the face of balance sheet only. The current liabilities we have short-term borrowings, trade payables, other current liabilities, short-term provisions. These will constitute the entire liabilities. And on the asset side, we have non-current asset and the current asset. Under non-current asset, we have plant, property, and equipment, tangible assets, intangible assets, capital work in progress, intangible assets under development. Then we have non-current investment, deferred tax assets, long-term loans and advances, other non-current assets. And in the current asset, we have investment, inventory, trade receivable, cash and cash equivalent, or we can say cash and bank balance, short-term loan and advances, and other current assets. I'll switch you to the Excel where we will cover that in detail. Give me a minute, please. Here it is. So this is what we had covered in our previous slide. The face of balance sheet, owner's capital account, reserve and surplus, and we'll cover it in detail. This is the format for statement of P&L, and we are covering the owner's capital here. We have the owner's capital account, which we can say interchangeably as the partner's capital account, or in sole proprietorship, the individual's capital account. In case of trust, we can say it is the corpus account, and it gives us the movement during the year with the opening and closing balance and share of profit coming up. Coming to the reserve and surplus, it covers all the reserves that are created by the entity, the undistributed surplus, and in case of any sole proprietor or any of the non-corporate entities, that is not that transfer entire profit and loss to the owner's capital. This will not applicable to that particular entity, and we can remove this particular section entirely. Coming to the non-corporate, non-current liabilities, we have some MSME requirements for the same. Current liabilities, trade payable, where it is. I'm just covering the major part. Also, for the long-term borrowings, there is something new that we have to disclose. It is the nature of the security. We have to specify. I'll highlight the same. nature, terms of loan, and if there is any loan which is guaranteed by the partner, proprietor, or you can say the owner, that should be disclosed separately. What does it mean? For example, I'll give you an example. Let's say Mr. X, the sole proprietor, and he gives a guarantee to personal guarantee to a particular bank on a loan. First question is whether that particular loan is considered as secured or unsecured. The answer is this particular loan is considered as secured because there is no charge created on the assets of that particular entity. It is the personal guarantee of the owner or the partner or the proprietor. That is why it is classified under unsecured category. Further, we have in the footnotes, we have to give details of all such kind of loans in each category. So this is something new in this disclosure requirement in this guidance note. Next, we will cover the current liabilities. Current liability and the similar thing applicable to the short-term borrowings. We have to disclose it separately, the short-term borrowings and the long-term borrowings, and all the disclosure requirement that is given under the long-term borrowings will are equally applicable for short-term borrowings. Under the trade payables, we have a requirement of a requirement from MSME that I'll cover. Give me a minute. Here we have the trade payables. In trade payables, we have to give the total outstanding dues of MSME and dues of creditors other than MSME. With the MSME and other than MSME, we have to disclose them separately. And from the MSME Act, other information are required about their outstanding principal and interest and their calculation part. This particular information, I think, is required under Schedule 3 as well. I'll cover it in detail. So first part is the principal and the interest. Let me unhighlight it and cover it one by one. The principal and the interest. What does it mean that? It simply means, for example, if you owe, let's say 10 lakh, if you owe 10 lakh rupees as on 31st of March or at the end of the period to the MSME, what does it mean? 10 lakh is the principal amount that is outstanding at the end of accounting year, and we have to calculate interest on that as per the MSME Act. In general, what I remember, it's a 3%, 3%, and the formula is simply principal into rate into time, the number of months it is outstanding, and we have to disclose it separately, the principal and the interest. What is the second part says? It is the amount of interest paid by the buyer in terms of Section 16 of MSMED Act, along with the amount of the payment made to subscriber beyond the appointed date during each accounting year. What does it mean? It simply means first we have to identify the payments made to MSMEs. We have to identify all the payments that is made to MSMEs after the due date. That is our first step. Second, we have to calculate interest paid on such delayed payments, on these delayed payment that is made after the due date, and calculate it separately. Then we have to add up the total amount paid after the appointing date. That means sum total of first thing and the second thing that we had calculated. And we have to disclose it separately. This is what point B mean to say. The principal amount, first we have to identify the principal amount that we paid after the due date or the appointment date, calculate interest on that, make a sum total of same, give the details of interest paid. Third point is the amount of interest due and payable for the period of delay in making payment, but without adding the interest specified under MSMED Act. What does it mean? Any payment that is made delayed beyond the appointment date and on which no interest as per MSMED is charged. We have to calculate interest that should have been paid. that should have been paid according to MSME Act for the delayed period. And we have to shown it as interest due but not paid, I can say, not actually paid for the C point. D point is about the amount of interest accrued and remaining unpaid at the end of each accounting year. What does it mean? It means we have to calculate interest on all the overdue principal amounts that remain unpaid at the end of the year by using the prescribed MSME interest rate, and sum of interest accrued but not yet paid by the company comes under here, point D. And E says the amount of further interest remaining due and payable even in the succeeding year until such date. What does it mean? In simple words, any unpaid interest amount from the previous year that is still unpaid in the current year, we have to calculate interest on that particular interest portion, or you can say interest on interest. And this amount further that may be payable in the future periods as well will comes under point E. Then we comes to our long-term borrowings. I already covered, I think, that part, the long-term borrowings. And this is the new thing here. On the asset side, again, I cover in our previous slides that the plant, property, and equipment, the capital work in progress. Work in progress is something we have to cover. In general, what we have seen that many corporate, non-corporate entities active with the PP schedule. So as per this guidance note, on the face of balance sheet, we have to disclose it separately. PP separately, intangible separately, CWIP separately, and intangible, which are under development separately. However, in the notes, we have to give the movements for to the same. Where is the PP note? Here. Here we have the disclosure requirement, the movement of tangible and intangible asset, the class of assets, freehold, land, building. Again, it's a thing to note here. Freehold, land, and buildings. Many people, many non-corporate entities shown land and building as a single item. We have to show land separately and building separately. Give a movement of gross block, its depreciation, and come to the net block. Same for the depreciation or any adjustment given, adjustment provided, and movement of CWIP during the year. Opening balance, any addition, CWIP capitalized during the year, and the closing balance. We have to show it separately. Then we'll come under the current assets. Current assets cover investment. Again, we have to disclose, in the notes, we have to disclose separately quoted investment and unquoted investment, current maturity of any long-term investment. As I gave an example of example of other buildings previously, that will cover under investment property will come here. And investment in any equity instrument, preference share, government trust, debenture, bonds, all the class of investment, we have to show them separately, and quoted and unquoted separately. Inventories, again, if it is a trading or manufacturing company where inventories are there, we have to show inventory, otherwise we can skip this thing. Trade receivable. Trade receivable, again, same. We have to show secured, unsecured, and doubtful trade receivable outstanding for more than 6 months and less than 6 months. from the receipt date reduced by any provisions made on them. It's similar to what we have in Schedule 3. Cash and bank balances, again, for the cash and cash equivalent purpose, we have two things, cash and cash equivalent and other bank balances. What is other bank balances? Any deposits which is having maturity of more than 3 months but less than 12 months. It is current but not the bank balance. It will comes under, it is not cash and cash equivalent. It will comes under other bank balances. Whereas the deposits having maturity of less than 3 months would comes under cash and cash equivalent, or any deposits more than 12 months would be considered as financial asset in general, but here we can show them in investments. It's cash on hand, check, drafts, similar to what we have in Schedule 3 here. Coming to the format for statement of P&L, we have revenue from operation, other income. It is again similar to what we are following Schedule 3. Any expenses includes employee benefit expense, cost of goods sold, finance cost. For the finance cost, I'll cover one point. You can say, let me cover it here now. Sometimes there is interest charge on non-corporate entities under section 234A, B, or C for the late filing of return, late payment of late submission of taxes of Income Tax Act under section 234 ABC, where that particular interest would fall. It comes under the finance cost. Depreciation and amortization on any intangible and PP, other expenses. I'll cover other expenses in detail because there is one point in this guidance note that would show that will guide us what we have to show separately. It's always a point of ambiguity what expense we have to show separately and what we can club under miscellaneous as a subcategory of other expenses. So these are a few points given here. What we will cover in revenue. Revenue, again, the sale of products, sale of services, any donation received, or any other operating revenue comes here under the under revenue from operation. Other income covers interest income, interest on bank FDs, dividend income, any gain or loss on sale of any investment would comes under other income. Cost of goods sold, it is again, if it is applicable, we have to give a movement of the same, otherwise we can skip this thing. This is mainly applicable for manufacturing companies. And similarly for the inventory details, we have to categorize it in stock in trade, work in progress, and finished goods, and give a movement of the same. Employee benefits would cover the salary, wages, or bonuses, or any other allowance given to the employees. Gratuity expense, any contribution made would cover here. Finance cost, interest expense other than on partner's capital. Other borrowing cost, if we borrowed any funds and paying interest on that, it would come here. Other borrowing cost, and depreciation on tangible and intangible, we have to show them separately. And also this particular figure should match from the schedule that we are preparing for the PPE. There we also have depreciation disclosure. And in other expenses, we have again consumption, power and fuel, all the other expenses that we can show separately. And one point I'll cover, miscellaneous expenditure in detail. Let me switch to my PPT. Allow me to switch on the PPT. We already covered this thing. This note I'm talking about. finance cost I already covered. It comes interest under section 234 ABC of Income Tax and Act can be covered under the finance cost. Any other non-operating income. Also, yes, I forgot to mention this point. Any other non-operating income. This particular guidance note allow us to show any non-operating income net of expenses. What does it mean? If we are having any income, non-operating income, and also we have any expense directly related to such income, we can net it off. We can shown as a net item and give in brackets, we can give it as a net thing. Other expenses that I am talking about is this point. What we have to disclose separately. Any item of income or any expenditure that is more than 1% of the revenue from operation. Let's say revenue for a particular period is 1 lakh and uh, um, give it a bigger figure. Let's say it's a 1 crore. Revenue for any particular period is 1 crore and there is any petty expenses. Let's say what I can say, telephone. Telephone is more exceeding the telephone expenses 1.5 lakh. Now you can say 1.5 lakh is more than 1% of 1 crore. So we have to show it separately. What if this figure is revenue from operation is 10 crore? Now it is less than 1.5%. Whether we have to disclose it separately again? Answer is yes. Because no. Answer is no. Why? Because even if it is more than 1 lakh, but it is less than 1% of the total revenue here, what we have, whichever is higher. If a particular expenditure, just to summarize, if a particular expenditure or the income is more than 1% of the revenue or 1 lakh, 1% of the revenue or 1 lakh, whichever is higher. If any of the conditions satisfy, we have to disclose it separately, an item of income and expenditure, even in other income or other expenditure. So this is all, guys, in the PPT. Gaurav, if we have any questions, we can open the session for the audience to have any question and answers.
Ashish, we have one question. Can a trust or society following formats prescribed in the specific state law regulators continue to do so instead of adopting the new format?
Can you please repeat the question, Gaurav? Any trust?
Can a trust or society following formats prescribed under specific state laws or regulators continue to do so instead of adopting the new format?
Yes, yes, Gaurav. This particular guidance note allow the same. Let me show you directly from the guidance note. It is given there in the guidance note. If that particular society is registered any state act, a particular act, and that particular act prescribed a format for preparation of financial statement, they can continue to follow the same. Let me show it you with the guidance note itself. Give me an example. Give me a moment to.
Yes, please.
Guidance note. Here we have the guidance note, and it is given in the scope here. Here it is mentioned. If you can see it on my screen.
We can.
Here, this guidance note is relevant for the purpose of preparation of financial statement of above mentioned non-corporate entities. Non-corporate entities again cover all forms of entities that is not registered under Companies or LLP Act, unless any format principles are specifically prescribed in relevant statute, regulatory, or any authority. For if again, this is the example that I covered in my presentation as well. Formats have been prescribed for the trust under Maharashtra Public Trust rules. So if an entity is registered under this particular act and they are following the format prescribed under this Maharashtra Public Trust rules, they can continue to follow the same.
Okay. Okay, Ashish, we have another question over here. Can entities omit line items with zero values for both current and previous years, or is it mandatory to present all the prescribed items? That I think we are talking about the financial statements part over here.
We can skip that. Even in the Schedule 3 and whenever we are preparing any financial statement, if there is no value both in the current year and in the comparative year, we can skip that particular line. Even the guidance note allows us to do the same.
Okay. Okay, we have another question. If an entity applies alternate procedures instead of following the guidance note, what document is the auditor expected to maintain? Okay, just I want to ask that instead of following the guidance note, if we apply for any alternative procedure, what are the external documents that auditor can ask from us?
It depends. First of all, as I mentioned during the applicability section, first of all, we have to analyze whether the services that auditor is performing comes under attestation service or not. First question is that if it is an attestation services, he has to follow the guidance note. And if also this guidance note is not applicable on the management of the non-corporate entity, they can deny that they can deny saying that this CA Act is not applicable on us and we are not following this guidance note. In that particular situation, what we have to do? We have to give a qualification in our audit report, wherever depending on which statute we are providing the audit report. As I give an example of qualification that the entity is not following the prescribed format, whereas it will not impact any numbers like the income, expenses, and any account balances. So first we have to analyze. And again comes to your specific disclosure. Let's say a particular entity comes under either of the level 2, 3, 4. It depends whether they are going for the full disclosure or the exemption. They are availing the exemption. If that particular disclosure comes under exemption, they are free to follow that. If there is any additional disclosure that they are providing, guidance note doesn't restrict us. And coming to the documentation, it again depends upon the auditor or the CA in practice. It's his professional judgment that what particular working papers are relevant for them.
Okay. Okay, we have next question. Suppose an entity is an MSME receipt and it gets converted into large entity or vice versa. How does it impact their disclosure? How does it impact their presentation? Is any is any restatement required for the comparative period?
No. If you can, I'll show you this particular thing from my slide itself. Give me a minute. I already covered with my example. Give me a minute. So from the slide itself, here it is. If an entity, what's your question? Whether it was converted from MSME to large, right?
Large or vice versa, anything.
Any. So these 2 points are covered here. If the entity, are you able to see my screen,
yeah,
the presentation?
We can, Ashish.
Yeah. So if an entity gets converted from MSME to large, first of all, they have to comply all the accounting standard right from the current same year. However, there is no requirement to revise the prior figure, comparative figure. There is no need to revise the comparative figure. However, they need to give a disclosure of the same. That the prior year we are having an MSME stated, but in current year, due to this particular reason, we get converted, our status get converted to a large, and all the accounting standards are applicable to us, but we are not revising the comparative figures. So this is the first case, and in the vice versa case, if any entity gets converted from large to MSME, they have to wait for 2 consecutive years. Unless and until that entity is maintaining a status of MSME for 2 consecutive years, they cannot avail any exemption.
Okay. So, Ashish, one more question over here. Won't there be any disparity?
There is a disparity, yes. It's a very good question, Gaurav. That you can say that the comparative figures are as per the earlier disclosures, and in the current year we are giving a different numbers. That is why the particular disclosure note is given, that we are specifically, they are mentioning that we are not disclosing, we are not changing the comparative figures. But
Okay.
yes, it's a disparity. Practically, it's a disparity for the users of financial statement. Yes.
Okay. Now imagine if a company is holding any crypto assets.
Crypto assets, yes.
Okay, where should be disclosed in the financial statements?
I think it again comes under the anywhere somewhere in the investments, either quoted or unquoted. Because if I relate it with the income tax, under income tax, it comes under the capital gain. We have to disclose details of digital assets, transfer of digital assets under the capital gain, and just relating it with the same, we can say that it is an investment for any non-corporate entity or the individual. Again, it depends upon the purpose, whether it was held for the investment purpose, or they are having a, let's say, a Bitcoin company. Again, it's a corporate entity, but if the business is of the cryptocurrency, it is shown separately as a stock item. Let's say for a investment trader who is having basis sale and purchase of cryptocurrency, it is stock for them, inventory for them. But in general, it comes under investment. This is what I believe.
Okay. It's a pure new guidance note that has been issued by ICAI. So I just want, okay, so we just want to understand what are the transitional challenges that might arise when we are shifting from the old formats that we had previously to this ICAI prescribed format. What will be the transitional challenge that we will face?
Normally, what I can, like, practically, I didn't get a chance to work on the such kind of things. But what I can think of is, like, all the entities are following the accounting standard even before the publication of this guidance, right? So they have all the data available with them. It's only the disclosure requirement, or you can say the format, that has been changed. Earlier, someone might be showing T-shaped format for the balance sheet. Now they have to show it vertically or horizontally. You can't say that someone doesn't have the detail of their plant, property, and equipment, because also in the past they are following the accounting standard. They should have the detail, maybe not in the same format, but in the different format. They should have the details of depreciation, I can say. They should have details of their inventory. What is the opening inventory? What is the raw material? What is the work in progress? What is the closing inventory? So more or less, what I can foresee in that the transitional changes is only related to the comparative figures, whether a particular accounting standard or the disclosure requirement is applicable on them or not. Maybe something is not applicable to them previously, now it is applicable to them, but for that, a guidance note gave an exemption not to restate the comparative figures.
Okay.
So I think there is no much transitional challenges that we can have apart from the disclosure things.
And what about the cash flow, Ashish, over here? Is cash flow mandatory for all the non-corporate entities?
No. No. Cash flow, like the accounting standard for the preparation of accounting standard, it is not mandatory for any of the MSME. It is applicable only for the large enterprises level.
Correct.
The particular standard itself is not applicable.
As far as I remember, cash flow statements are not applicable for small entities also, who are having turnover 50 crores or less, something like that.
Yes, that comes under MSMEs, level 2, 3, and 4. It is applicable only for the level 1 entities, large entities. having a turnover more than 250 crore and borrowing more than 50 crores.
Okay, we are receiving one more question, Ashish. The question is, if a company has had any prior period error in the previous years, and that error need to be rectified in the current format, that how do accounting policies will shape under the new format, and how it should be taken care of?
Prior period item, it depends again. Like we have to follow the prior period errors in that particular case, which is applicable earlier as well. There is no change in applicability of that particular standard here. Prior period and error should be rectified, and depending upon what kind of error it is, we have to make a disclosure. For example, if I'm just putting it as an example, if there is a change in accounting policy, we have to make give a disclosure of what is the change, how it is impacting the P&L statement, how it is impacting the retained earning. We have to give a disclosure of the same. The same thing is applicable in this case.
Okay. Another question we have, Ashish. Are non-corporate entities allowed to customize the line items in the prescribed financial statements format? For example, can we add or remove certain items, or this is the freeze format? We cannot make
it is not the freeze format. As an example, I quoted in Schedule 3 what we have, shareholders fund. But for the non-corporate entities, there is no shareholding available. We have here owner's capital. Let's say owner's capital, or in the prescribed format, exact language what we are using is the format gives us owner's capital account. Let's say you are preparing financial statement of a trust. There we don't have any owner's capital, we have corpus. So we can change it, like instead of equity and liabilities, we can say corpus and liabilities. Or we can say capital and liabilities in case of any partnership firm. So they are not a freeze format.
I think so. This we are talking about the nomenclature over here. Can we add or remove? Okay, like in Schedule 3, we have a prescribed format for balance sheet. We have a prescribed format for PL. If you add or remove something, a certain guidances has been given under Schedule 3 that with an expense more than 1%, you can add or remove the line item. Is there anything that we can add or remove in this?
Yes, we can make any changes for the purpose of better disclosure, as it is mentioned itself in the guidance note, and I covered it in my PPT as well, that this guidance note, the disclosure requirement, disclosure in the prescribed format are addition, not the substitution. Let's say if there is something, let me give you an example, related party note. Guidance note doesn't talk about related party note, whereas from the accounting standard or from the Income Tax Act, earlier also we are disclosing the related party things. So we have to disclose it now as well. So this is an addition which is not prescribed in the guidance note, but guidance note specifically doesn't say you don't have to disclose it. So if there is anything not particularly restricted by the guidance note, or even if guidance note restricted something, but it is made mandatory from the accounting standard, the accounting standard will prevail. If there is nothing mentioned in the guidance note specifically, but there is a disclosure requirement in accounting standard, you have to follow the accounting standard and give the relevant disclosure in the financials.
Okay, now let's take an example over here that I'm getting question. XYZ Foundation is not for profit organization working to uphold the rights of children in India. Okay, it prepares financial statements that are subject to audit. Guidance note on financial statement of non-corporate entities is required to be applied by preparing financial statements for XYZ Foundation.
Again, yes, the tax audit is applicable on that, and the CA in practice has to issue tax audit report for that non-corporate entity, right? Just to summarize the thing, there is a non-corporate entity which is not following the prescribed format earlier. Now the tax audit is applicable on them, and the question is whether they have to follow this guidance note or not. So there are 2 points here. First, whether that entity has to follow this guidance note. Answer again is no, because this guidance note is not mandatory to be followed by the management. It is only the chartered accountant in practice on which this particular guidance note is applicable through the code of conduct or the past announcement. Management can say that I'm not bound with the CA Act, but the member in practice is bound with the CA Act. So here the chartered accountant who is signing the audit report and who is attesting the financials should first of all consult the management, try to insist them that this is the guidance note and for the better disclosure and parity purpose we have to follow them. Still, if the management resists to follow the same, they have to qualify the 3CB report. Put a qualification that management is not adhering to the financial statement, but there is no misstatement in the numbers. Again, the kind of qualification we are providing is not adherence to the prescribed format. It's not about the qualification on the numbers or any misstatement we are giving.
It is just a format we are talking about over here.
Yes. So the CA in practice has to follow, but because the management resists to follow the same, the CA in practice has to put a qualification in his report.
So this is the auditor role. Or is
Yes.
there any additional role that auditor need to take care of?
I'm not covering only the auditor here. I'm just saying the CA in practice. If there is any kind of attestation service he is providing of, let's say not taking the example of tax audit.
Okay.
Any entity is in the process of taking bank loan and that bank demands the entity to produce financial statements duly attested by a chartered accountant in practice. And that particular financial statement is after the covering the period on or after 1st April 2024. That is the effective date of this guidance note. Now the question arises again the same. CA in practice has to follow this guidance note and ask the entity to prepare financial statement in the prescribed format. If entity agrees, then it's fine. If entity doesn't agree, he has to put a qualification.
See, this is my personal doubt. There are two things. One is auditor, one is CA in practice.
Correct.
Auditor has a responsibility to audit the financial statements.
Correct.
If any NC non-corporate entity are not complying with the prescribed formats, format issued, then the auditor has the right to qualify.
Yes.
An auditor will qualify that they are not complying with this guidance note, not with the numbers or format. Correct?
Yes.
Now a CA.
It's only about the adherence to the guidance format.
Correct. Point well taken. Now we come to another point. The another point comes to CA in practice when there is certain attestation needs to be done. Correct? Can a CA in practice ask for a financial statement to comply with the guidance note even though auditor has already qualified in the previous audit report?
Again, we need to analyze what is the risk here. First of all, CA in practice, who is providing attestation services, has to comply with the guidance note and the prescribed format. This thing is very much clear, whereas the management is not bound. Now, to your specific question, in case of this non-corporate entity, auditors already qualify his report that the management is not adhering to the prescribed format. And now he comes to the attestation services to another CA in practice, maybe for the bank loan purpose or any other purpose. Now, again, in his report, something has to be issued on the letterhead of the CA in practice. So in that particular report, he has to mention the same thing, that this entity is not adhering to the prescribed format of guidance note. Again, the risk is of the CA who is attesting the services. So he has to apply the professional judgment. What kind of remarks he has to put on his letterhead.
Okay. And what other rules does auditor need to ensure in compliance with the guidance note?
Can you please elaborate a bit on this question, like what are the rules means to say?
What are the role of the auditors to ensure compliance with this guidance note?
It's similar to like for the companies, we are preparing set of financial in a prescribed format given by the Schedule 3, right? Similar kind of thing is prescribed by this guidance note. So we have to ensure that whether the entity, let's say an entity, it's a sole proprietor firm who is preparing his balance sheet in T format earlier. Now they have to comply with this format. If they are not complying it, auditor has a right to qualify the statement. Put a qualification, not to qualify the entire financials. Put a qualification with respect to adherence of the format.
Okay. We have another question over here, Ashish. What is the applicability of the technical guidance? Technical guide on financial statements of non-corporate entities, which was issued earlier in the year 2022 in the specific context of introduction of this guidance note on the same subject.
It was recommendatory in nature. In that guidance note, in that technical note itself, technical guide itself, it was written that it is recommendatory in nature. So either the CA in practice or the management, they are on their free will whether to follow it or not.
See, we are having another question. If MSME classification is not furnished by the management, do CA has the right to qualify this? And if yes, how?
It is a specific question like providing the details of their MSME status. It's again an audit part. It's not related to this guidance note. It is an audit thing, how an auditor would check the status of that of a particular entity. Again, if it was registered under MSME Act, they are having some certificate of registration. It's a similar question like how an auditor can verify that a particular company is a private company or a public company with a certificate of incorporation. In the similar manner, they have the certificate of registration under MSMED Act. And even on the, as far as I know, on the MSMED Act, it's a publicly available portal. You can check over there. And if there is something identified by the auditor, again, he has the right to put it in his audit report.
Okay.
That right was given by the available to the auditor.
Okay. We have another question over here, Ashish. Can entity who are covered under level 4 can voluntarily adopt all the standards which are applicable to the entity covered under level 1?
Yes, they are free. Guidance note doesn't make any restriction. They can, I think it is specifically written in the guidance note itself. If an entity is free to apply all the standards voluntarily.
In that case, what are the implications that entity level, that level 4 entity will have?
There is no as such implication. It's a better disclosure.
It's a disclosure. And now we have another question.
Let's say, let me put out a question like here. For a non-corporate entity, all level 2, 3, 4, there is no requirement to prepare the cash flow statement. What if someone prepare the cash flow statement? There is no harm in that. It's just a better disclosure. It's only about the efforts that they are putting on in preparing the cash flow statement.
Okay. Got it. And how should the comparative be presented in the first year of incorporation or first year of adoption, better to say?
There is no requirement to give the comparatives. It is specifically mentioned in the guidance note. If it is a first year of incorporation.
Okay. Ashish, we have, I think so, next question. Can a cooperative society issue consolidated audited financials in the revised ICI format while preparing unaudited branch-wise financials in the old format for internal use?
You're talking about this question 15?
Yeah.
Can a cooperative society issue consolidated audited financials in the revised ICI format? Branch-wise financial in old format for internal use. It again depends on which period we are talking about. If it is after 1st of April 2024, they have to give all the financial in the revised format.
Okay.
And the CA who is attesting the same has to ensure that thing.
Okay. I think so. We have this much question, Ashish. Okay.
But practically, just extending this particular question, as I covered in my example, a sole proprietor firm is going for a state subsidy, and the state asked them to produce 5 years of financial statement duly attested by a CA in practice. Now, out of those 5 years, only 1 year cover comes under the preview of this guidance note. The question arises, first question is whether CA in practice has to follow this guidance note. Answer is yes, otherwise they will qualify. Second question arises, whether we need to prepare financial statement of all those 5 years in the same format. On books, I can say requirement is only for the 1 year. But practically think how it looks like if you are providing 5 set of financial statement, 2 in different format, 3 in different format. Practically, they'll prepare in the same format. Similar thing applicable to this particular question number 15. It comes under the same period. They, in general, in practice, will prepare the financials complying with the guidance.
Okay, got it. Great. Thank you, Ashish. Thanks a ton for that insightful and comprehensive session. You have not only highlighted the technical aspect of recent developments, but also clarified the practical implications for us as a professional working closely with non-corporate entities, I must say. Okay, if anyone has any other question, I think so they can visit the ICI website where FAQs has been published by ICI on this guidance note. You can have rest of your questions answered over there. See, Ashish, I personally believe as a member of this profession now, we have an important role to play in driving awareness and readiness among our clients and organizations.
Correct.
This is not about ticking compliances boxes. See, there are a lot of compliances with respect to MSME, ICI, revised AS that we are having, tax audit, but it is not only about ticking compliances boxes, but also building a robust financial system that can support long-term growth, funding, and especially creditability.
Yes.
See, on behalf of ASB, ICI, and all those participants who have joined, I extend my heartfelt thanks to you and to everyone who joined us today. We hope you found this session informative and thought-provoking. Thank you once again, Ashish. We look forward to see you in coming webinars. Everyone, stay safe. Keep learning.
Thanks
you
everyone for having me here. It's a wonderful session. Thanks, Gaurav. And thanks the entire team of ASB to conduct this session without any glitch or so smoothly. Thanks a lot. Have a nice day.
Thank you, everyone. Bye. Have a nice day.